You built something. Maybe it's in US, Europe, or Asia, doesn't matter. Now you're moving to Canada and you're wondering, what happens to my business? Do I have to tell anyone? Will Canada tax this? Here's what a lot of people don't realize until it's too late. Immigration and taxes are not separate conversations. They're connected, and the choices you make in months one can affect your liability for years. So let's sort it out. Hi, I'm Anastasia Nesvit, Toronto corporate and immigration lawyer with over 10 years of experience, and I work with founders who move to Canada every month. In the next 8 minutes, we are covering three things. First, what actually happens to your existing business when you become a Canadian resident. Second, what you need to tell to Canada Revenue Agency and what you don't. And third, this is the big one. Will Canada tax your foreign income? So you land in Canada. Your business does not disappear, but your tax residency changes. Canadian taxes are based on residency, not citizenship. The moment you establish residency in Canada, and residency is pretty straightforward to establish, which usually happens within a few months of your arrival, a resident of Canada for tax purposes. Now, what does it mean for your business? If your business is already incorporated overseas, let's say UK, Singapore, PTE Ltd, or US LLC, it is still a separate legal entity. It does not magically become Canadian just because of your tax residency, and you don't have to bring it here. But, and this is really important, Canada now has the right to tax certain types of income you earned from your existing foreign business. We will get into the specifics in a minute. The decision you have to make upfront is this. Do you keep your existing foreign company as is and just manage it from Canada? Or do you incorporate a separate Canadian entity and manage it alongside your existing business? There is no one-size-fits-all desired structure in here. It all depends on your current business structure and ownership, whether you have co-founder, okay, what assets your foreign company has, and your timeline here in Canada. But you do need to sort this out with a lawyer, a cross-border accountant, before you move, not after. Because once you are resident, the tax clock starts ticking. So here is the practical question. Do I need to tell Canada Revenue Agency that I have a foreign company and foreign property? The answer is yes, not optional. Let me break down what you're reporting. First, foreign income. When you file first Canadian return as a tax resident, you are required to report all worldwide incomes. It would include income from your foreign company. However, it does not necessarily mean that this income will be taxed. If your company earned $100,000 last year, and you are a Canadian tax resident, you are required to report this. Even if you leave the funds in a company's bank account, and even if you never touched it, the CRA or Canada Revenue Agency will ask in the Form T776 if you ever earned a rental income, or this will be on your general return if this is a business income. Also look at your bank statements, and they will cross-reference this with international tax information sharing agreement. So you cannot really hide this, and you shouldn't try. Same thing with the foreign property. If you own real estate, equipment, intellectual property, or investments outside of Canada, you should report this. There is a form called Form T1135, Foreign Income Verification Statement. If your foreign property exceeds 100,000 Canadian dollars in value, you are required to file this form. Not filing this form leads to penalties, and we're talking about thousands of dollars in penalties, even if you don't owe any taxes on this property or income. But what do you actually report? Here is where it actually gets practical. You report the existence of property and its value, and you also report the income it generates. You don't necessarily need to provide your entire corporate structure. However, you do need to be transparent about what you own and what it earns. This is why we recommend having this conversation with your lawyer and your accountant before you land in Canada. Because if you got significant foreign income property, and especially if you are concerned about how it will be taxed, you want to file voluntarily disclosure or set up your reporting properly from the day one. It is way easier and cheaper to do it right the first time. Alright, here is the question that keeps business owners up at night. If I move to Canada and my foreign company keeps operating overseas, Will Canada tax the income it earns? The honest answer is it depends. I know it's frustrating, but hear me out. The nuances do matter. If your foreign company is earning active income, it conducts business, it earns selling something, providing a service. The income that stays inside the company is generally not taxed by Canada. And here is why. Your company is your separate legal entity. It is incorporated and resident where it is located. It files taxes there, it pays taxes there. Canada does not automatically tax the profits your company earns just because you're now a Canadian tax resident. That would be double taxation, and Canada specifically has treaties that avoid this with the majority of the countries. But when you take the money out of your company, this is when Canada gets involved. If your foreign company pays you a dividend, Canada taxes it. If you take out a salary, Canada taxes that. If you use company assets for your personal benefit, Canada may also treat this as an income to you. So the company's earnings may be protected, but your extraction of money from the company is not. Now, if your foreign company is not running a business, if it's just sitting on investments, property, or financial assets, it gets taxed differently. Income from foreign investments, foreign rental properties, or foreign corporations can be subject to Canadian taxation. This is trickier because now we are in a treaty territory, and the rules vary based on which country the income comes from. Canada has tax treaties with dozens of countries. These treaties are designed to prevent double taxation. They set out the rules of who gets to tax what. For example, if you have a US LLC earning US business income, the Canada-US treaty usually says the US taxes it first and you don't pay this amount twice. But the treaty rules are different from different types of entities, different types of income, and different countries. This is exactly why you need a cross-border accountant, because the difference between a US C Corp, a US LLC taxed as a partnership, and US S can mean tens, thousands of dollars in Canadian tax liability. Let me give you a practical example. You have a US company earning $200,000 in profit. Now you're in Canada. If you incorporate in Canada and leave a US company dormant, you save yourself hundreds of thousands. You save yourself hundreds of hours and thousands of dollars in professional fees. You start fresh with Canadian tax efficiency. If you have co-founders in the US or significant contracts tied to the US company, winding it down may not make sense. So you keep it. The company earns $200,000. It stays in the company. Canada does not tax $200,000 directly. But the moment you need to take $50,000 out as dividend, Canada taxes you on that. Depending on your structure, you may pay 25 to 45% in Canadian taxes on that amount. Could you have structured it more efficiently? Maybe. Should you have sorted it out before you move? Absolutely. This is why this conversation matters upfront. Here is what you actually need to do if you're in this situation. Step 1. Inventory. Write down upfront what foreign businesses do you own, what foreign property do you own, what's it worth, and how much it earns annually. You don't need to be perfect, you need to be complete and honest. Step 2. Consult a cross-border professional, not just a Canadian accountant, not just a US accountant. If your business in the US, you need someone who understands both jurisdictions and how they interact. Because a mistake here can cost you tens of thousands of dollars in unexpected tax bills or penalties. A good consultation, even if it costs you $2,000 or $3,000, is an investment and not an expense. Step 3. Get it in writing. Once you and your professional have a plan, get it documented. What are you keeping? What are you winding down? How will you extract money? And how you will report that. Have this sorted out before you file first Canadian tax return, because this return is your first formal Canadian declaration on your worldwide income. And step 4 is file properly. Your first return as a Canadian resident is crucial, as it sets the precedent. If you do this right, you sleep at night. If you do it wrong, you deal with the audits and adjustments for years. This is not the place to cut corners or hope that CRA doesn't notice. I know what you're thinking. This is complicated. Should I just sell my foreign company before I move? Maybe, or maybe not. Selling a foreign company can trigger capital gains, corporate taxes, and all sorts of complications. Sometimes it's cleaner to keep it, but sometimes it's not. Will CRA audit me because I have a foreign income? Not automatically. CRA audits based on the risk profiles. Report it. If you don't report it correctly, or if you don't report it at all, risk goes up significantly. What if I become a Canadian citizen? Citizenship does not change tax residence. If you are taxed based on where you live rather than based on your citizenship. If you eventually leave Canada, there might be some additional departure taxes, which are a conversation for another time. Yeah, but how long do you need to keep records for your corporation? CRA can go back 6 years for audit, but your accountant probably will recommend you to keep your records indefinitely. Because if something comes up in a year 7 and CRA would like to go back and take a closer look, you do need to you would want to have your documents intact. Here's what I really wanted to take away. Moving to Canada with a foreign business is not something you can figure out on the fly. The people who do this well, those who minimize their tax liability, protect assets, and sleep at night, are those who have these conversations up front. They sort out ownership structures, reporting obligations, and extraction strategies before they arrive. If you're in this situation or about to be, reaching these owners and founders coming to Canada every month, we have sorted out each variation of this problem. You can find us at neswithlaw.com or call to book a consultation. We'll walk you through your situation free of charge. No fees for the initial consultation. The cost of getting this wrong is way higher than the cost of getting this right, so sort it out up front. Thanks for watching.